Tim, thanks for joining us today.
Yeah, so so basically, we first want to start off by saying that to anybody who's watching and anybody out there, we hope that you're doing okay, and we know that these are just uncertain times. And
hmm
so we hope that today and throughout these sessions we can help provide you and your family with some certainty. So,
Yeah, there's a lot going on right now, and I know that we haven't had a lot of contact between a lot of people. I know you've probably seen Cassandra and I making a lot of videos, but we're doing the best we can to make sure that we're staying safe during these times. How about you, Tim? How you been staying? Right.
yeah, me
Yes.
too.
Yes.
Honestly, me too. I won't lie to you about that.
Okay, Tim, give us 1 second here. It appears that we can't hear you again, and that's probably the reason why right there. All right. So go ahead and talk, Tim.
Can you
All
hear
right,
me now?
so we're gonna have to go ahead and reintroduce ourselves, but that's all right. Now that we can hear you, Tim, my apologies. The computer always has some kind of an issue. So once again, I'm Vince Coralejo,
And I'm Cassandra Olson.
and this is Tim Rowan from Stanford Mortgage. He's our
Hey, everybody.
preferred mortgage lender, and we were just talking about staying safe during these uncertain times right now, and we're just making sure that everybody out there is doing well and is staying safe during COVID right now. So.
Yeah, we as the Better Together team, we really like to do whatever we can to serve our community. So if there is anybody watching that needs any type of assistance, help, or anything of the sort, please reach out to us. We'd absolutely love to help you. So, yeah.
And Tim?
Yeah, the same is true for us. We were just kind of joking around about it a few minutes ago. It's kind of this has become the new normal, right? And my wife just told me yesterday she's tired of hearing that phrase, the new normal. But the reality is, we're trying to find out how we can best help people, and this is kind of the new normal.
Yeah, agreed.
So
And I think that, I mean, looking at, the virtual homebuyer seminar that we're doing right now, everything's going virtual right now, the least amount of contact possible.
Yeah, and, it's been hard to stay out of contact with people. I'm a hugger. So I'm having a hard time not hugging everybody I see. I'm walking down the street with my dogs. I'm like, well, I just want to hug you.
yeah, well, these are real issues, right? It's interesting, and I know this is kind of a sidebar, but I think it's okay. For the first time in I can't tell you how many years, I wasn't with my mom or mother-in-law yesterday for Mother's Day.
Yeah.
Normally, that's a day where the families gather and gather around. And what we did was a Zoom call. That was the Mother's Day.
Everything's virtual.
Yeah, happy Mother's Day to all the moms out there, by the way.
Exactly. Yes, yeah. Happy Mother's Day. That's so great.
Yes.
We had a really good day yesterday. We made a s'mores board where we made s'mores on a board. I posted it on my Facebook a few days ago.
All
It
right.
was so good. It was so good. So anyways,
great,
guys,
yeah.
Let's get into this. Before we dive down into the deep analytics of what we're going to be talking about, we first want to talk about why us. Why are we holding this seminar? And essentially, we're holding it because we understand there's a lack of knowledge, when it comes to what it takes to purchase a home and the home purchasing process. We've been hearing a lot, of stuff going around.
Yeah, and I think that a lot of our friends and family are, we've had a lot of fear-based feedback based off of what a recession is and the current times we're in. And so we're here today to bust the myth of I'm waiting for the market to crash. And so that's what a big part of our section of this homebuyer seminar will be about today.
Yeah, so we're from Century 21. We work at the Folsom branch, and we happily work there. We love our company. We are the only Century 21 here in the greater Sacramento area, and Tim is actually our mortgage affiliate. So, Tim, you want to talk a little bit about that before we dive in?
Sure, yeah, and I got to tell you, the model in which Stanford Mortgage works, we're a division of Finance of America. We are, of course, affiliated with Century 21 and Select Group in general as a whole. Lenders, we all pretty much do the same thing, and there's no big news there. However, I will say this: today, it's more important now than ever before to be able to still work with somebody local. Now, I was going to say it's great when you can come into the office and sit down with a mortgage lender, but actually right now you can't come into the office and sit down with a mortgage. But when you can deal with someone locally, right, we're seeing lots of things take place and lots of changes take place in the lending industry. And so versus dealing with someone online and where you might talk to 6 or 7 people in a transaction, it's more important now than ever before to be able to deal with someone locally. Really, that's kind of what we hang our hat on.
I couldn't agree more. Oh
yeah,
my goodness.
I mean, that's why we're partnered with Stanford.
Yeah, and you guys are you're just 5 gold stars to you, Tim. So thank you for being here today. I'm most happy that you're here because we're going to talk about something that sounds a little bit scary, and it's the word recession. And honestly, we're here to talk about why it's not that scary of a word. And so, Tim, I think we're going to dive straight in. And, what we want to ask you is, are we in a recession? And does a recession automatically mean a housing crisis and decrease in property value?
All right, let me bring up.
Awesome. Let me. You guys going to bring up that first slide?
I'm going to bring it up right here, and we're ready.
Some fruit on it.
Yes,
the apples in the apple, or orange in the apple.
Apples and oranges. So one right out of the gate, Cass, good for you by just throwing the recession word out there, right? A lot of people don't want to talk about it. To be clear, you go 2 quarters in a row with GDP issues, and we won't get too detailed on, but that's what meets the definition of a recession, excuse me. And let's not beat around the bush. That's where we're in. That's where we're headed. And the main key here is does that automatically mean a drop in property values? Well, you can see the slide. It's really apples and oranges, and that's what we want to spend a few minutes talking about.
Yes.
A recession doesn't automatically mean a housing crisis by any stretch.
Cool. So we're going to go ahead and go to this next slide here.
So then, Tim, because you said that, we want to talk more in depth about that. If it doesn't mean that we're automatically, everyone keeps saying, I'm waiting for the market to crash. Can you talk a little bit about why that is not necessarily a true statement and how that applies to what we're going through right now? And we're on the second slide.
We're on our second slide.
Yep, I changed up. Thank you. I'm watching Vince's clicker finger there. Yeah, so let's take a look at some recessions from 1980 and then move forward through the conversation. And so what we're showing here is home price indexes, meaning prices having gone up or down during each of these recessions. And you'll see that both in 80 and 81, we had increase and slight increase. And then in 91, we had a slight decrease in property values for a short period of time. Now, what's interesting is I'll just share with everybody that I bought my first home in 91. And at that time, and you guys will get a kick out of this, at that time, it was like, you got to buy. Property values are going up, right? Mm-hmm. And so I bought just before property values started to slide off slightly. My interest rate was 11.75% when I bought my first house in 19.
That's unheard of.
Right? Isn't that crazy? But then interest rates came down. There's a lot of economic reasons to this. And then values started going up. And then in the 2000s with .com and, of course, September 11th, we had back property appreciation again. And then, of course, we head into 2008. Where obviously we look at 19.7% housing decrease. That was, a lot of us remember, you guys don't, your parents remember, right, when this happened, which is one of the reasons why we have a lot of fear of home ownership today, truthfully, is what happened in 07 and 08.
Ultimately fear of recession, because that is what people are now accommodating the word recession with. Is that correct?
You're spot on that, Cass. That's a great comment to make, and you're exactly right. And so here's what's important to point out about 2008. Our industry would actually look at this and say it's an anomaly, because what caused that in 08 was, in fact, the very industry that I work in, right? There was some lending practices, and we're going to show some stuff as we go through this presentation.
Mm-hmm.
Right.
But we really created the problem, right? That we went through.
And I think that's what kind of gives us like
what's
that.
Interesting is,
go ahead. Sorry.
Yeah, of those 5 recessions that you're looking at that bar graph of, only 2 times did property values actually go down.
I think that's kind of a common myth that we kind of think of, right? Recession, oh my God,
property values
are going to plummet, right?
And that's why we're here today, because we'd actually just really like to talk about that.
Yeah.
But so, Tim, what you're saying is, in the course of recent history, out of the 5 last recessions, in only 2 of them, property values decreased. Is that what you're saying?
Mm-hmm.
That's correct.
Okay, so we're on to the next slide. And the next slide
so this is the big question, right?
Yes.
Is this going to be like 2008?
Like 2008. Like everybody keeps saying. What does everyone say to you every time you talk to a new client?
I'm just waiting for the market to crash.
I'm waiting. I got a call yesterday. I got a call yesterday that said, "Hey, I want to buy a house in Folsom for $150,000 when the market crashes." And I said, "So does everybody else."
And I think that's what we're all just kind of waiting for, right? Yeah. And I think that by going over these terms and everything, we're going to get you there.
So Tim.
Yes.
Is this going to be like 2008?
Is this?
Well, let's dive into this. If you guys can bring up the next slide, and let's really dive into it, and I'll let some people come up with their own.
All right, we're on the next slide
conclusion. Here. Okay, so let's take a look at housing and the mortgage crash and the depreciation. You'll notice 07, 08, 09, with the biggest number being negative 10% in 08. I was there for that, by the way. I was in the business for that. Interesting times. We saw a huge correction at the S&P. We won't get too off into the economics of that. Heavy depreciation, but here's the good news. It's a little bit different time than it is when we look at recessions past. So go ahead and click on the next slide for me.
Okay.
Well, Tim, can we stay there for 1 second? What I want to talk about is, can we talk about why property values decreased? Can you give a little background on what was the factor that made these property values decrease?
Yes, I can. And we do have some slides later talking about credit and lending policies that led us up to that time. And we'll get there. But I will just quickly touch that the big difference between that time frame versus the time frame that we're in now is we were not looking at a time and place where homeowners had equity in their homes. They were being allowed to finance 100 and in some cases beyond 100% of their home's values. Okay. So when that happened and all of a sudden these mortgage products, and we could get really detailed about this, but from a Wall Street perspective, all of a sudden these loans couldn't be bought and sold in the secondary market and everyone was holding paper that, guess what? They couldn't even recoup that money because there was no value in the property to do so. That's what started to drive the market back the other direction.
And that's why we have the biggest decrease in 2008, obviously.
Right.
And following it.
And Tim, would you also say that's because, and Vince and I were just talking about this right before our call today, would you also say that that's because, when people, couldn't pay their mortgages anymore due to losing their jobs or, anything of the sort, not qualifying for the mortgages that we're going to talk about here soon, that we had to go into short sales. And when as a realtor, when we're pricing a house, when someone says, okay, I'd like to sell my house, we price it based on a listing price.
Right.
Based on the comparables in that neighborhood.
And as you watch the prices, when the mortgage company is trying to just get their money back compared to losing the whole loan amount, I mean, wouldn't that drive the housing prices down?
Well, it did. And you also had a demand issue too. Remember, just basic demand. And the reason we ended up with short sales is, to your point, Cass, you can only sell a house for what the comparables justify for it, right? When you're doing appraisals, and you ended up having home values, you could sell a house for less than what was owed, thus the term short sale. You're selling it short of what you owe. And that definitely led to all kinds of problems. Now, that's different when you're in an equity type of market, right? When a homeowner has equity, and again, we'll continue to talk about this, and I'll just throw it out there right now. But let's just say right now, today, we know that unfortunately there are a lot of people that have lost their jobs right now, or at least laid off or furloughed. And Lord, we're all hoping and praying that everybody gets back to work really quickly as we get through this. And we will get through this, by the way. That's my crystal ball moment for you. But here's what's different. When this happened in 08, people were like, oh, I can't afford my mortgage payment anymore. Well, they couldn't even sell the house for how much they owed because of the lending guidelines allowed them to borrow, again, 100+ % of the home's value. Today, that is not the case. 53% of home ownership, people have 53% equity in our country nationally.
Wow.
In their homes. So even in the worst case scenario, folks that have lost their jobs, they're like, gosh, we just can't afford my house anymore. It's not going to work. They're in a position to sell it and still make a gain.
They're able to still make
ends
meet. Mm-hmm.
That's right. That was not the case.
Which is what made the market crash.
Right.
Prices dropped.
Yes.
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 Thank you.
Yes.
Okay, great. So we'll go on to the next slide. And Tim, why don't you explain what this slide means and why it applies to what we're talking about?
The post,
Yeah. So what I want to talk about here is it was in 9/11. Obviously, we all remember 9/11, and I wanted to do a comparison here of where we're at currently in our current recession situation, and do a comparison of the two. So in 9/11, so we had property appreciation all the way along the way, and in fact, if we were to take this scale out even past '02, what we'd see is lower interest rates, more buyers, coming into the market, driving prices up, and so on and so forth. Kind of actually led us up to '08 to some extent, right? Mm-hmm. Because that's when lending really started to get kind of
it was loosey-goosey, right? And that's what we're leading into.
Yeah, you guys, you remember we were talking on a phone call last week, and you laughed when I made the comment that, shoot, if you could fog a mirror, you could get a loan.
Yeah, I mean,
kind of crazy stuff. But here's the interesting comparison. Property values went up as a result of this recession. And I want to remind everybody or talk about the fact that during this recession, one thing is very interesting and I think is a good comparison to what we're at now. If you remember after 9/11, people stopped going to crowded places such as restaurants. They stopped traveling on air travel. They stopped going to large sporting crowded events or concerts. And they did it in that case because of fear, right? Fear is what drove that recession. Do any of these things sound familiar today?
Sounds like we're living in 2020.
Right? So I think it's an interesting comparison. This time was not necessarily economic driven or because people lost their jobs. We headed into a recession because of fear of an additional terrorist attack. Right? Today, we're headed into a recession because of fear of being in a crowded place and getting sick. And rightfully so, right? So it's interesting that we recovered from this much quicker. I don't really have a crystal ball. I wish I did. But when you start analyzing this a little bit, you look at it and go, okay, well, maybe the recovery mirrors more of what it did after September 11th versus what it did in '08 by far. You see what I mean?
Well, yeah. And going back to your point of like people that are in their houses now can afford their homes. Right. And back then, they were just barely making ends meet. And looking at the two comparables right now, we have people who are in their homes that can afford them. And we're going through a crisis right now.
Well, Vince, talk about that because you have a story about that. And I want to elaborate why people could not afford their homes in 2008. So why don't you share your story? Because I think a lot of people and a lot of our viewers and people in our sphere will relate to your story and will give context to what we're talking about.
Yeah, so I remember living we lived in Vegas before we moved here in 2008, and my parents were in a loan, and I think that their payment was like $1,700. Well, all of a sudden, their $1,700 payment went up to $3,000, and we weren't able to afford the house. And that was because they were in an ARM loan, adjustable rate mortgage. And so I think that this is what really dictated the crash. Am I correct, Tim? Right? And do you still use ARM loans today? And
yes, we do, but not the same type. And it's important to understand that. Now, I don't know exactly what that situation was, but I can tell you what was very, very common leading up to '08, what was called an option ARM loan, which meant you could choose, you, the homeowner, could choose to make one of four payments. So check this out. You could make a minimum payment. You could make an interest-only payment. You could make a 30-year fully amortized payment or a 15-year fully amortized payment.
Yeah.
Well, Now, if you're given the chance of making those payments, and this one is the minimum, which one do you think you're going to make?
The minimum.
The minimum.
Yeah.
Well, what a lot of folks, and unfortunately didn't realize, is that when you make the minimum payment, not only are you not paying any principal, you're not even covering all the interest. Your loan balance was actually going up every month. Well, '08 swings along, and guess what? It's time for this option ARM to reset, and your payment literally doubles overnight.
Wow.
That's what happened to his parents.
It had to have happened, right?
Yeah.
It was like the flip of the switch.
No. Yeah, we don't have option ARMs anymore.
Okay.
So that's a big point of this, is that quite literally, Vince's parents
Mm-hmm.
could qualify for their $1,700 a month mortgage.
Mm-hmm.
They could afford to pay that. But then overnight, when it changed to $3,000, they're like, we have to sell the house. We can't afford this. And that's what happened to so many who lost so much in the crash.
And I know that would leave a bad taste. That would leave a bad taste in my mouth, And so, and especially if you were not really quite sure exactly what happened, I think this is why we're doing this class, is to educate you and to not feel that way again. Because even today, I'm sure there are people that still feel that the residue or whatever of 2008 of not feeling good about purchasing a home, not feeling confident,
Yeah, or worried that their house is just going to get taken from them because they don't qualify anymore.
Mm-hmm.
Yeah, and actually what you guys are speaking to can very quickly be summed up this way, and that is trust. And consumers lost a lot of trust in the banking system, industry, platform as a whole, truthfully.
Absolutely.
I agree.
And it's like, well, gosh, so that's why obviously the three of us have gotten together and said, okay, well, how do we help educate people with this? Because by the way, the result of what happened in 2008, and we'll see some more data as we move forward, completely reinvented the mortgage business. And again, I went through that time. It was not pretty. And so lending guidelines tightened up. And I know it sounds crazy. Now, homeowners that currently have a home in the last 10 plus years, I promise you, absolutely qualified for that mortgage payment, because the days of doing a loan just when you could fog a mirror have long since gone away.
And we see that every day, because honestly, it's not hard, but you have to have your ducks in a row to qualify. If you have everything set up, you can buy a home, but you can't just walk in having just gotten a good job. And you have to have your job for 2 years. So you can't just say, oh, I just got this brand new job, let me go get a nice new house. You actually have to prove that you're committed to that job, have the 2 years of experience and paid taxes in order to even get it. So I think that's important.
Yeah, or when someone kind of comes up and says, hey, you know what I mean? And you're like, not really, because we're not speaking the same language anymore.
Yeah.
And they're almost trying to tell you how it is. And you're like, it hasn't been like that for...
Make it work.
Make it work. And it's like, it really hasn't been like that for quite a long time.
Yeah, well, so what's interesting is, and we'll try, and I won't get too sidetracked on this, but as a result of 2008, and there were lots of new rules and policies and procedures put in place, all for the better good, by the way. Painful to go through sometimes, but all for the better good. But now when a file is underwritten, it has to be done from a perspective of what they call ATR, and that stands for ability to repay. So ATR did not exist leading up to 2008. We were not underwriting loan files based on somebody's ability to repay. Go figure.
I was going to say, you would think that would be in there somewhere, right?
You would think so.
Hey, you want a loan? You get a loan. You get a loan.
That's how it was, though.
That's really
and that's why the market crashed. Now, if we can compare that to today, which is what we're trying to do, we can see that not you get a loan. You have to qualify. And so this probably brings us to the next slide. Am I right?
I believe so.
Yeah, are we going with our annual price appreciation slide?
Yep, that is it.
Okay, so this is actually really interesting to look at, and this is what led up to 08, and then it gives us in the blue for the last 6 years leading up to where we are now. And you'll see in all cases there's property appreciations, but look how much larger the appreciation.
I was going to say, look how much it fluctuates, and you can tell in 2001, which is the lowest, but then it just started going way higher, and over the past 6 years you can see that it's much more stable.
It's leveled out. And why is that, Tim?
Yeah, why is that?
Well, here's why it is because remember, anybody and everybody could virtually qualify for a loan. Mm-hmm. And because of that, it started driving prices up. And when it drove prices up, in order to qualify people, you had to come up with even more creative loans, no income loans, no asset loans, stated income loans, high loan to value loans, meaning 100% plus financing. And by the way, and there's been movies made about this, right? Mm-hmm. Where this stuff just kept getting rated and sold on Wall Street. Lots of people, it's just craziness going on, right? Well, you'll see appreciation numbers that were never seen before. Quite honestly, everyone's heard the term the bubble, right? When's the bubble going to burst? It had no choice. I mean, oh my gosh, it was getting carried away. Well, let's look at the appreciation in our market for the last 6 years. Much more the norm. right? 4.5%, 5.5%, 4.8%. These are much more sustainable equity and appreciation gains leading up to this. I hope you guys can see the
Yeah,
difference.
because if you
one
look,
is like way up.
yeah, if you look at leading up to 2008, I mean, the fact that everybody was able to qualify for loans, I would imagine that the market would be more of a competitive, right?
Mm-hmm.
You have, well, I want this for this. Well, you have to come in maybe a little bit above, which is gonna raise appreciation.
And that's where you're talking about trust, where the trust was
Mm-hmm.
lost in our industry because realtors and everyone else was like, yeah, bid higher, bid higher, bid higher, because you get paid more for that.
Mm-hmm.
But that can't happen anymore. If your property doesn't appraise, you don't get to pay, that money for that property. You have to negotiate it back down. So I think that that's really something to be said, is that, now we can't offer those deals anymore. You can't just escalate the price of property like that so quickly.
I think there are still a lot of people out there that think it still works like that, though.
Yeah,
I really do.
Yeah, and by the way, Vince, if you'll click to the next slide,
no problem.
we can demonstrate this in big fashion. So we keep talking about the run up, right? And so this is mortgage credit availability. I want you to think of loans that are made available to people, right? And how easy.
The available amount of money.
Yeah, look at where that index headed. You can see where it dropped. I mean,
it went tanked.
Yeah,
but since then,
all
look
of
what
a
it's
sudden,
done.
all of a sudden the banks, they couldn't sell this loan. So all of a sudden the lending guidelines started tightening up, rightfully so. And it came down. But here's what's really cool to look at. It's basically just a flat line. Right.
It's gradually
leading us all the way up. Yeah, all the way up to today. So what this is an indication of is the changes in credit necessary, income necessary, qualifying necessary for loans. We have not been just doing loans for people that don't actually qualify for them.
Anybody who's watching right now, take a screenshot of this. They need to see this right now, because I feel like...
Well, I mean, and Tim, can you talk a little bit about this? And Vince and I were talking right before this call, and just touch on this briefly. Was that amount of money available because of, I remember back after 2001, after 9/11, I remember George Bush was president, and I remember that the bank said, okay, lighten up the reins. Mm-hmm. We want to open the floodgates. Let's get people into homes, and let's boost up the amount of money that we have available to get those people into homes. Now, is that accurate? And then is that a reason why this all came to fruition?
Well, yes. And in fact, even if we back up, just talking about it, backing up, you don't have to back up in slides. But remember, after September 11th in that recession, it was a fear issue, much like we're dealing with COVID today. Mm-hmm. And so how do you stimulate the economy? Well, you do it by dropping rates. You do it by making borrower money more affordable. Mm-hmm. And in that time, easier. So what they did is they said, look, we're going to make mortgage lending available to virtually anybody. Right. Well, that started running everything up, values up, everything, and it was because interest rates were coming down that spurred people to buy money. And so if we look at even what's just going on in the last couple months, right out of the gate, the Fed came out and dropped the Fed rate almost to zero, basically, which, by the way, has no real correlation to mortgage money. Just to be clear on that, mortgage rates aren't zero. Okay. Not yet.
When they are, you better let us know.
I'd be the first to let you know. But what they're doing is this is how they're trying to find ways to stimulate the economy. They're going about it similar to the way they did back in 2001, but it won't be the same way, the stimulus that led us up to 2008 from 2001. And the difference is this graph right here.
Right.
The difference is the lending guidelines. They're not going to just be giving money to anybody and everybody.
I mean, even leading up to 2000, what was it? 2008. I mean, you can see that it still was way up there compared to where it's at even today. It's not like you're seeing major spikes,
Oh, well, all of a sudden, look, let's be brutally honest here. Big corporations, big banking platforms saw an incredible opportunity to be very, very profitable. There's a lot of behind the scenes stuff. Again, we won't get too detailed about it. But basically, any type of loan program would get a 5-star rating. It was sellable on Wall Street, even though, quite honestly, it was those people never qualified for that loan. Mm-hmm. But those things don't happen anymore. Right. I mean, I can show you stacks of paperwork and guidelines and, everything that prevent that type of thing from happening. But the one interesting part is we are back down to a situation of historical lows in rates. And I have to tell you, it actually bothers me to say that, because for the last 10 years, I found myself on numerous occasions in the marketplace going, rates are historically low. Honestly, it's kind of getting exhausting to me, like the new normal. It's like, well, are they really historically low? Because 2 years ago, Tim, you said they were historically low. But really, it's true. You know, it's crazy just kind of what's going on with the market and the Federal Reserve's place in this right now. They actually think that interest rates are going to be at this low range for the next year to 2 years, which, by the way, is another reason this will very closely mirror what happened after September 11th. It's how they will stimulate the economy.
Well, it makes sense on why people need to come to our seminar. So when they're ready to buy with these low interest rates, they're ready to go, right? Instead of not knowing what to do.
And just as a side note, we will be talking about the lower interest rates and affordability of how to buy a home in our next seminar. So I just want to throw that in right now. This is not the only time that we'll be talking about that, but we're not going too deep into it at the moment.
Yeah, by far. We're definitely next week, we're going to jump in, I know, and spend some more time on the affordability aspect, because really that's the key.
Yeah.
Home housing is truly, truly affordable right now.
Hey, Tim, I'm going to bring up the last slide too, just because it's pretty much shows the same thing as what we're looking at right now, but numbers. Is that okay?
Yeah. Well, so here's what's interesting. You're on the equity cashed out.
Yeah,
right?
That last one. Yep.
Okay. So, and this is some good numbers. So if we look at, again, the 3 years previous to 08 leading up, look at how much cash out in the billions people took out. $824 billion.
Man,
that wasn't,
man.
I didn't get $824 billion.
We wouldn't be sitting here if that was the
case. Right. And keep in mind that this was a result of the values running up that we were showing, 14.5% gains in property values. And more importantly, lending guidelines at that time allowing them to go take all of it from their house, right? Remember, they owed more on the house than what it was truly worth based on lending guidelines back in that day.
And then look
at the last 3 years. Yeah, look at the last 3 years now. This is a direct result of the change in lending guidelines and a tightening, if you will, to really be tightening down lending and keep it with people that are qualified and stuff. $232 billion. It's a quarter. You know what I mean?
It's literally a quarter, and so we need people to hear that now.
And and how you were saying earlier about how people weren't even paying their interest, and that's where this number comes from. It's like if your monthly payment isn't even going towards anything, it's just adding to this deficit of money owed and money borrowed.
Right.
Yeah. And just so you know, what's interesting about this is over the last 10, 12 years, and of course, this is just reflecting the last three in both scenarios. Keep in mind, if someone's doing cash out on a refinance on their property, you can't even go beyond 80% of the home's value. You're forced into maintaining a 20% equity position. Leading up to 08, shoot, I'd get you anything you want.
Fog and mirror, you get what you want.
Fog and mirror, we're getting in.
It was an interesting time. I'd have clients that would come meet with me, much like you guys do, and they would ask the question. They'd say, well, we need to meet with you. We need to find out how much we're pre-qualified for. And back in those days, we'd say, no. I don't. Yeah. I need to know how much you can afford because I can qualify you for anything. How scary is that?
And that is not the way of the world now. It is not the way of the world. So much stricter now.
I think if we could just focus on that, I think that would dispel the whole I'm waiting for the market to crash, right? I think that point alone really hits home with this
and I think one thing we need to touch on is how strong the market has been leading up to this. I mean, if the house was priced right, it would get 15 offers on it. I mean, if talk about a competitive deal, and so those 15 buyers haven't just dropped off the face of the planet. We still see buyers in the market, and yes, there are less sales happening because of everything going on, but it doesn't mean that the buyers still aren't looking and waiting for some of these things to get lifted.
Agreed. And to know, how to act on it.
So let's just approach this from a basic economics supply and demand concept. So it's important that we all remember that prior to COVID and prior to what we're experiencing today, we still had a supply versus demand issue, meaning we didn't have enough supply for demand. not just here in California, but nationally, we have a housing shortage. That hasn't changed.
Right.
Okay. We still have a housing shortage. As we come through this, we're still going to have a housing shortage. I mean, you guys see it. They're still building lots of new construction, trying to keep up with the demand. Have things from a purchase standpoint slowed down a little bit? Well, of course. You can't go outside. You have special arrangements to go visit a property. We're doing virtual open houses.
And I can't tell you how many times, you get a client, they're like, that's great, but I want to go see it in person. And it's like, well, we're living in weird times right now.
Yeah. So what's interesting is, and of course we don't have a slide for it. We can have one in the next week or two if you want. But what's interesting, a report conference call that I was a part of a week or two ago showed some very interesting forecasting numbers in real estate, which is very promising for us because for the last 8 weeks that we've all been involved in this, everyone's been interested to see what's going to happen to home sales. And more importantly, is there any way to forecast what the future looks like? Mm-hmm. Well, they're now forecasting that for the next 24 months, interest rates are going to maintain historical lows, right? Okay, so that's good. So that's what's going to continue to work in the favor in regards to affordability, right? Mm-hmm. Well, they're also now forecasting a 0.5% increase in property values year over year. Now
say that one more time for the people in the back.
So here's what's interesting. The forecast is not calling for a decline in home values. Now, to be clear, every marketplace is a little different, right? Those are national numbers. But here's what's interesting. Because the demand is so high and the affordability is so good right now, they're not expecting property values to plummet.
And that would be back to what you were talking about back in 2001.
Right.
It's pretty much the same thing, right? People can't go anywhere.
It's not like property values increased by 7%, but they certainly didn't decrease. Right. And that's what we're looking at right now.
Right. Yeah. So it's interesting. I know myself and a couple of our mortgage advisors, we have a lot of conversations around this topic right now. And if someone was coming to us or you and saying, I want to buy a house and I'm going to sell it next year and I hope to make $50,000. Honestly, my advice would probably be now's not the time for that. If someone's coming to you, though, and they want to take advantage of how affordable housing is, and let me say it this way, if they want to buy a home instead of a house, if they want to buy a home and it's with their children in the right school district and the shopping areas, there may not have ever been a better time.
Right. Absolutely. That's what we're here for. Yes.
What? So, I mean, and obviously, guys, I know we've got a ton of stuff we could stay on forever.
Yeah.
Forever.
But the fact of the matter is hopefully you guys feel like we've been able to dispel the myth a little bit about a crash in the housing market. Because there's just not, and this isn't me, this is other companies and banks in the industry and CoreLogic and all these different people coming up with these numbers, these reports, and these forecasts. And so, things
you're the guy who looks into them and reads them.
Well, Tim, I want to touch on this. Because we're on this subject of recession. We're on the subject of how this recession is different from the other ones and all that. So we want to talk about this because now we finished our presentation of the slides. We want to talk about why you should buy versus rent. And so we're only going to talk briefly about this because we're going to go more in depth in this when we talk about affordability and loan programs and how much you need for a down payment. But essentially, what we've been talking about and what we've talked about with you is that in a recession, rent goes up. Mortgage prices stay the same. Or you refinance and they go lower.
They go down.
So can we talk about that for a moment?
Yeah, absolutely. And by the way, I think that's a lead in or a teaser, if you will, for next week or this Thursday. Did I say next week? I think we're going to try and go live again Thursday.
Yes,
Thursday.
Yeah. And so, and I know we're going to dive into this and I have some great reports that I can show everybody at that time. But Cash, you're exactly right. When you look at the past recessions from a renting perspective, the one thing was constant, and that was rents went up. And actually in 2008, rents went up quite a bit as a result of 2008 because you had a lot of people selling homes that had zero equity in them, right? Remember, we talked they were short selling their homes.
Right.
And now there was a huge need. Now they didn't qualify to buy another home. I mean, they just walked on the one they were living in, right? And so now there was a need for rents. Well, here again, it's a supply and demand issue. And guess what? Rents started going up. And that has been the case in each of these recessions. Rents have consistently increased. So from a security aspect, if you're thinking of buying a home, you're currently renting, you go, my gosh, if I bought a house and I paid $400,000 for it today and my mortgage payment was $2,000 a month, here's what I can promise you. Your mortgage payment will be $2,000 a month for the next 30 years, unless you refinance it, which, Cass, to your point, would be if you want to drop the payment, right? Do debt consolidation or whatever, improve your financial situation. How's that? What's interesting, though, is when you're a tenant, not only are you paying and someone else is paying down the principal and interest, that money's gone from you forever, right? And you're at the mercy of the landlord. Yeah. So you're at the mercy of the landlord, the property management company, whatever the case might be, for increased rents. And if rents go up, well, if you want to continue to live there, you have to pay the increased rent. Right. And so one of the things we're going to dive into next week, and I'll show you some real numbers on this, a rent versus own comparison, where we'll see that in the first 5 years of paying rent, it equates in this much money being gone. And it's going to come up as a big negative graph, right? That's a real number. Whereas if you look at it on a purchase, you're going to see $30,000 and $40,000 in principal reduction. And we like to call it forced savings, right? So every time you make a payment, $400 or $500 of it is going to principal. Think about that for a second. That's again, forced savings. Maybe that's, overstating it, but it'll be fun.
No, not at all.
I don't think so at all, because this is what I want to touch on too, because as realtors, when we're selling a home, we're not just selling a home, we're selling an investment. And essentially what we're saying is, and I'll use the house that we're in right now as an example, my dad's house, who he bought it 20 years ago. He bought it for $275,000. If this house is fixed up and nice and in the right condition, he could sell it for at least $600,000. So in 20 years, he made $325,000 of investment money that, if taken care of, if you take care of your property and you do everything, you're supposed to, you take good care of your investment, it will make money for you.
And he's been paying his mortgage,
which he now has, he bought it for $275,000, but he has equity in it. So now he used the mortgage capital, which we get from you at Stanford.
The forced savings.
So we have that we're paying down. That now, when we go to sell the home, we get to keep all of the increased appreciation, as well as the savings that we've been paying down to you for the mortgage. And so I think that's so powerful and something we don't talk about enough.
Well, we don't talk about it enough. And honestly, it's no fault of the potential home buyer or even homeowner, that because people are not trained to think this way. Here's what people are trained to think. I think I want to buy a house. What's the interest rate?
Right.
Okay, that's great. But what is the effect? And in fact, again, I said earlier, it's really important to be dealing with someone local right now, that we can have these conversations. And you guys have heard me say it ad nauseum. We need to build strategies for our buyers. Yes. What is the strategy? Not for today, but for the next 5 years, the next 10 years. Maybe it is a short-term strategy, right? And if so, is now the time to be in the market? Or would you be better to build a strategy to come in later? Everyone's situation is different. So building a strategy is what's really key.
Is to realize that everybody's on their own path, and they all have their own financial needs, and I think that's where we come in. Them up for
that's
the future.
Where we come in.
So.
Right. Well, we all work together, right? And it's like, what's the best strategy for that potential home buyer? It's interesting because we've talked a little bit about today equity position that homeowners currently have. People that have owned homes for the last 10 and 12 years are in tremendous equity positions, and it's a great position to be in. But let's just say someone has a home and they're at 4.75%. By the way, that's a real number, just even less than a year ago, right? But they're in a 30-year mortgage of 4.75%. Maybe it's a 3-bedroom, 2-bath. Now they have an extra child, or maybe they want to relocate to a different area. Does it make sense to refinance that house into a 3.25% rate? Or does it make more sense to sell the house, take their equity position, and go buy another house at 3.25%? In other words, you could literally buy up or down and might be paying the same or less than you're paying now.
Exactly.
Right?
That's the beauty of this. Gosh, I love that.
Yeah, well, everyone's need is different, right? I say it all the time. Needs and wants, and in fact, pain. What are those things? Let's focus on addressing those, and again, build a strategy, right? So, what's the best strategy for accomplishing their goals?
And I think that will leave home buyers with more of a, like, I have a plan rather than I'm just making a payment.
Right. And I want to say, Tim, that's a perfect lean into next week. What's the best plan? What's the best program?
Yes.
Right? Which is where you come in and say, hey, these are the different loan programs I have. Here's how they're affordable. Here's what you have to qualify for to make these loan programs. So that's a great segue into next week, or Thursday also.
Yes.
I keep saying next week.
Yeah.
I keep saying next week. By the way, I'll just say on a side note, I don't know if I have to get a different light or not, but your guys' lighting is phenomenal. Like, I look all gray and old and stuff. Look at you guys.
We're fancy over here.
You know what I mean?
We're fancy.
I don't know. I got to get a different
I'll hook you
light
up with the light I got.
Shout out to Eric Hatch for that. Thanks,
Eric Hatch.
Yeah.
But yeah, okay.
We want to thank everybody for coming today. And I think on the last note we wanted to make sure is, before we go into next week, is you don't need 20% down. I mean, I think that's a big that's like the big myth will be.
We want to leave that cliffhanger. We want to leave that as the end, as come on Thursday to figure out how much money you really need to buy a house. Because now that we know the market isn't crashing, now that we know property values,
what's it going to actually take to get in?
We don't have a crystal ball, but we do, see this forecasted. And Tim, I just appreciate you so much being so articulate and really laying it down in layman's terms for all of us to be able to understand, what we're looking at.
I totally agree.
Yeah, well, we're going to get through this. I promise everybody we are. I mean, we're strong and resilient people. And so we'll deal with this. I hope everybody stays healthy, really. Part and with open houses, and you have all your COVID stuff and your wipes and your cleaners and your masks and doing all the virtual stuff. So we just keep on keeping on, right?
Yeah, absolutely. And so, just, tune in Thursday. We're going to go over different loan programs, affordability, what interest rates are, and, what they mean for you when you're looking to purchase a home. And you don't need 20% down. Come learn why. All right, you guys, we're the Better Together team.
Take it easy, everybody. Thank you again, Tim. We'll see you Thursday.
Thanks,
Thursday
guys.
the 14th between 4 and 5.
All right, happy Monday, guys. Thank you so much.
Yeah, so